Alright, so let's be honest here. That company earnings report just dropped, and for most people, it looks like a wall of confusing numbers and corporate jargon designed to make your eyes glaze over. You might even be making investment decisions based purely on a headline or a tweet, completely missing the goldmine of information hidden inside. Have you ever felt that wave of confusion wash over you when you try to decipher what adjusted EBITDA or non-GAAP earnings actually means for your hard-earned money? Are you wondering if you're missing crucial red flags or, even better, incredible opportunities that are staring you right in the face just buried a few pages deep? Well, guess what? You're not alone, but today, that all changes. In this video, I'm going to break down exactly how to dissect an earnings report, piece by piece, in plain English. We're going to cut through all the noise and get straight to what matters. I'll show you the key metrics that professional investors look at, how to interpret them, and how you can use this knowledge to make significantly smarter, more informed investment decisions. This isn't just about understanding numbers. It's about understanding the health, performance, and future potential of a company you're considering putting your money into. And trust me, you're going to want to stick around until the very end, because the insights you'll gain today could fundamentally change how you approach investing. We're talking about the difference between guessing and knowing, between following the herd and finding those undervalued gems or sidestepping potential disasters. By the time we're done, you'll feel way more confident looking at these reports, and you'll have a clear framework to analyze any company. This is the stuff they don't teach you in school, but it's absolutely critical for building wealth. So grab a coffee, maybe a notepad, and let's get into it. Alright, first up, and arguably one of the most straightforward yet crucial numbers to look at, is revenue growth. Think of revenue as the total amount of money a company brings in from its sales of goods or services before any expenses are taken out. It's the top line, the starting point. If a company isn't growing its revenue, it's like a car trying to accelerate with an engine that's sputtering. It's a fundamental indicator of demand for what the company offers, and its ability to expand its market share. Without growing revenue, it's incredibly difficult for anything else in the financial picture to look good consistently. Now, when I say revenue growth, I mean we're looking for a positive trend. Is the company making more money this quarter compared to the same quarter last year? That's your year-over-year growth. Also, how does it compare to the previous quarter? That's sequential growth. Consistent, strong revenue growth tells you that the company is doing something right. It's a sign of vitality and momentum. Understanding these factors is key because not all revenue growth is created equal. Is it sustainable growth, or was it a one-time bump from something like a big asset sale that won't be repeated? You want to see organic growth from the core business operations, so always dig a little deeper than just the headline percentage. For example, if CloudSpark's growth was due to a massive, one-off government contract that's unlikely to renew at the same scale, that's less impressive than if it came from a steady increase in subscribers across their diverse product suite. The former might look great for one quarter, but the latter suggests a more robust and repeatable business model. This distinction is crucial for forecasting future performance, which is what investing is largely about, trying to predict the future or at least make an educated guess. So how do you spot these revenue growth trends in an earnings report? First, look for the income statement, sometimes called the statement of operations. Revenue or sales will usually be the very first line item. Okay, so the company is bringing in revenue, which is great. But here's the million-dollar question: are they actually making any money from that revenue? This is where profit margins come into play. Revenue is what you earn, but profit margin tells you what you keep after all the bills are paid. A company can have massive revenues, but if its costs are even more massive, it's still losing money. There are key types of profit margins: gross, operating, and net. Gross profit margin is profit after direct costs like raw materials and labor. For example, if a bakery sells a cake for $20 and the ingredients cost $8, the gross profit is $12. A higher gross margin means good control over production costs. Operating profit margin subtracts operating expenses like marketing and R&D. This margin shows how efficiently the company runs its core operations. Finally, net profit margin is the percentage of revenue left after all expenses, including taxes and interest. A higher net profit margin indicates strong financial health. When reviewing earnings, look for stable or expanding profit margins. If revenue grows but profit margins shrink, it could be a red flag. It might mean rising costs or price cuts to win sales. For example, if CloudSpark's revenue grew 30% but their net profit margin fell, investigate why. Are they investing in future growth or facing competitive pressures? To calculate net profit margin, divide net income by total revenue and multiply by 100. So if net income is $10 million and total revenue is $100 million, the net profit margin is 10%. Alright, we've talked about revenue and profit margins. Now, let's get a bit more personal with earnings per share or EPS. This metric is super important for you, the individual investor, because it directly tells you how much of a company's profit can be attributed to a single share of its common stock. Think of it as your slice of the profit pie. If a company earns a profit, EPS breaks that profit down on a per-share basis. It's a very common way to gauge a company's profitability from an investor's standpoint. So, how is it calculated? In its simplest form, EPS is calculated by taking a company's net income, after preferred dividends if any, and dividing it by the average number of its outstanding common shares during a period. For example, if Global Corp Inc. had a net income of $100 million and had 50 million shares of common stock outstanding, its EPS would be $100 million divided by 50 million shares, which equals $2 per share. This means for every share you own in Global Corp, the company earned $2. Investors watch EPS very closely. A consistently growing EPS is often a sign of a healthy, growing company. When EPS increases, it generally means the company is becoming more profitable, or it's buying back its own shares, which reduces the number of outstanding shares, thus increasing EPS even if net income stays the same. A little financial engineering there, but often seen positively if the company believes its stock is undervalued. Rising EPS can make a stock more attractive to investors, potentially driving up its price. Let's look at a real-world type of example. Imagine a well-established company, say Steady Savers Bank. Over the past 5 years, Steady Savers has consistently reported rising EPS. In year 1, it was $3, then $3.30, then $3.70, then $4.10, and this past year it hit $4.50. This steady upward trend indicates that the bank is effectively growing its profits relative to its shares outstanding. This could be due to increasing loan volumes, better net interest margins, efficient cost control, or a combination of these factors. For an investor, this consistent growth in EPS is a very reassuring sign. Let's talk about something critical: cash flow. Cash is king in business. Profits on paper don't matter if there's no cash to pay bills and salaries. Cash flow shows the real story. Think of it like personal budgeting. You need actual cash to cover expenses. Companies are no different. The statement of cash flows is crucial. It breaks down into 3 sections: operating, investing, and financing. Each tells a different part of the story. A healthy company shows positive cash flow from operations. Alright, let's tackle a topic that can make or break a company debt. Just like for individuals, debt for a company can be a useful tool, or it can be a crushing burden. Companies often take on debt to finance growth, fund acquisitions, or manage short-term cash needs. Used wisely, debt can help a company expand faster than it could using only its own profits. However, too much debt, or the wrong kind of debt, can lead to serious financial instability, especially if the company's earnings falter or interest rates rise. When a company takes on debt, it's obligated to make regular interest payments and eventually repay the principal amount. These interest payments eat into profits, reducing net income and EPS. If a company has a very high debt load, a significant portion of its earnings might go just towards servicing that debt, leaving less money for reinvestment in the business, dividends, or weathering economic downturns. It's like walking a financial tightrope. One misstep, and things can go very wrong. Consider a company, let's call them Leverage Corp, that went on an acquisition spree, funding it mostly with borrowed money. Initially, their revenue and market share might have increased significantly, making them look like a growth story. However, their debt levels ballooned. Now, they face huge monthly interest payments. If the acquired businesses don't perform as well as expected, or if there's an economic slowdown and Leverage Corp's own revenues decline, they could find themselves struggling to meet those debt obligations. This is a classic risk of high leverage. The risks involved with high debt are numerous. First, there's the risk of default. If a company can't make its interest or principal payments, lenders can force it into bankruptcy. Second, high debt reduces financial flexibility. A heavily indebted company might not be able to invest in new opportunities, respond to competitive threats, or survive a prolonged period of poor business conditions. Third, credit rating agencies might downgrade the company's debt, making it more expensive to borrow in the future, creating a vicious cycle. So when you're looking at an earnings report, or more specifically the balance sheet, which shows assets, liabilities, and equity at a specific point in time, you need to assess the company's debt levels. How much debt do they have relative to their equity, owner's stake? This is measured by the debt-to-equity ratio. How much debt do they have relative to their assets? So there you have it. We've dived deep into the world of earnings reports, looking at revenue growth, profit margins, earnings per share, the all-important cash flow, and those tricky debt levels. It might seem like a lot, but by focusing on these key areas, you're now equipped to look beyond the headlines and truly understand what's going on under the hood of a company. You can spot the difference between a company that's genuinely thriving and one that's just putting on a good show. This knowledge is your new superpower in the investing world. Now, if you found this breakdown helpful, and I really hope you did, please do me a huge favor and smash that like button. It really helps the channel out. And more importantly, comment below. Let me know if you have any questions, or tell me which company's earnings report you're going to dissect next using these tips. And of course, if you haven't already, hit that subscribe button and the little notification bell so you don't miss out on more videos designed to help you build your wealth and financial understanding. We're just getting started. Remember, understanding these financial statements isn't just about making more money, it's about gaining confidence, reducing risk, and taking control of your financial future. It's about moving from being a passive observer to an active, informed investor. As Warren Buffett says, risk comes from not knowing what you're doing. Well, after today, you know a heck of a lot more. So go out there, use this knowledge, and start unlocking those secrets.